Well, this is our first podcast, so we'll see how we do. Dipo, you want to introduce yourself and tell us a little bit about your background?
Sure. I'm Dipo Ashiru. I'm the General Counsel and Chief Compliance Officer at Veritas Capital. Been with Veritas Capital about 4 years. We are a private equity firm. Primarily, we invest at the intersection of government and technology. What that means is we focus on industries that have a strong overlay of government control or government influence. So things like aerospace and defense, healthcare, education, and infrastructure. And so we've been an investor in this space ever since the beginning. It's part of our DNA, and that's what we do. And we currently manage $54 billion in AUM.
So not much.
Not much.
I feel like I have to introduce myself because this is a podcast
You should.
and we are going to have a chat. So I'm Katie St. Peters. I'm a partner in our investment funds group at Kirkland. I've been practicing as a funds lawyer for 15 years, so pretty long time. I've been at Kirkland for 12, and I focus primarily on raising equity funds. So I work a lot with buyout sponsors and big buyout sponsors like you, although we don't work together.
Right.
But also all the way down the stack. So I work with emerging managers, venture, growth equity. I like to do a lot of different things because it keeps things interesting and keeps you plugged in with the market. So
That's cool. I guess we have something in common. I'm also a funds lawyer by training and background. So I started at Debevoise a while ago, once upon a time, 2007. So that was right before the financial crisis. Interesting times in the market. I was at Debevoise for about 4 or 5 years, and then went to KKR in-house. And that was my first in-house stint. And I was at KKR for about 5 years as well, and then moved to TCW Group. So more of a credit exposure, traditional asset management shop before I joined Veritas. So I've kind of evolved from being a pure funds lawyer only to a more of a generalist along the way. But I'm always excited and happy to meet another funds lawyer.
yeah, well, we are so fun. Okay, so we talked first in our panel about sort of what investors are thinking about right now. And I feel like let's start with what we talked about, which is sort of like, hey, you had this great successful fundraise. What were investors thinking about in your fundraise?
Yeah, so just for context, as you said, we had a fantastic fundraise. And for those who don't know, we just raised our 9th fund, buyout fund, and we raised $14.5 billion in a pretty tough market. We're pretty proud of that accomplishment and very excited to have all the new LPs that we're partnering with, as well as our old LPs who have sort of like re-upped with us and remained committed to us. But yes, conversations were quite different from the prior fundraise, which happened about 3 years ago when I just joined Veritas. This time around, I feel like LPs are generally focused on some of the same themes, but what we find is they are spending more time on those issues and themes and digging deeper and being less willing to be accommodating and more willing to negotiate and ask for more favorable terms, given the switch and the change in sort of like the market dynamic. And so what do they care about? Information rights, for some reason, is a very, very big issue for LPs now. They want bespoke reporting, bespoke information. So like templates, they want us to give them information the way they want to cut it with their own technology platforms and their own vendors. And so negotiating all of that creates a huge operational sort of like burden that we now have to take on as sponsors and GPs. But information is what we trade in, right? In this market and in this space. And so understanding that, I can see why LPs also care about that. I want to make sure they understand what's going on, not just on the surface, but in the portfolio at a very granular level and within the funds as well. Fees. LPs always want to have lower fees, and that makes sense, right? Fees are how we make our money, but fees are what LPs also pay to have access to the products that we offer in the market. And we're finding that the pressure and the downward pressure on fees continues to increase, and LPs are also looking for creative ways to lower the fee burden. So I call it like their version of dollar cost averaging into like each investment opportunity, looking for co-invest opportunities, for example, to allocate more. LPs are looking in many instances for a 1-to-1 ratio of like fee paying to non-fee paying exposure, which is very hard to get when you think about it, because the opportunity set hasn't necessarily increased that much in terms of like, available deals or whatever, right? But yet there's a lot of capital that's flowing into the space. And so LPs want more co-invest, which means you're giving less allocations to your funds.
Well, co-invest is tricky, right? Because you want to be able to say, yeah, of course, everybody can co-invest with me. But if the co-invest flow isn't there, then you've promised something that you can't deliver.
Yes.
And that is really tricky. Like, I think that sponsors that I work with are spending a ton of time trying to think about what can we actually accommodate. Like, if each investor is coming in and saying, well, we want 1-to-1, all of a sudden you're investing, a fund double the size of what you were intending to. And maybe that's great. Maybe your strategy scales and allows you to tap into companies that you wouldn't have otherwise been able to buy. And that's fantastic. But there might still be a great opportunity set right in the sweet spot of your fund size where the allocation really belongs with the fund. And so I feel like I have ended up, particularly with some of my smaller sponsor clients, where the sort of incremental co-invest can really move the needle on their deal flow, with people not necessarily feeling super comfortable being able to accommodate all of the demands that they're seeing on co-invest.
I think you hit the nail right on the head. Allocation is going to be a factor, and it's going to be a challenge. For a firm like ours, we do pretty chunky deals. We're thematic investors. We know what we want and we know our niche, and we focus on those. And so when we find an opportunity that we have high conviction behind, we go all in on it. And so sometimes that means we're writing pretty large checks for the companies that we're buying because they're large sort of like buyout opportunities. And so I'll give you an example. In the last fund that we raised, Fund 8, we have about 6-7 investments in that fund over a $10 billion fund. That means you're cutting check sizes of like $1 to $2 billion on average. There is going to be opportunity for co-invest as a result, because it's hard to come up with all of that equity, especially when you're thinking about your concentration limits for a fund, and how you size your deals to make sure you don't have too much of an exposure risk-wise, right, in terms of diversification. And so co-invest can actually help with solving some of the pressures that you feel in that regard when you're a sponsor like ours who does what we do. A typical, traditional PE sponsor might have 15 to 20 deals in their funds. We're not that kind of investor. And so high conviction, sometimes concentrated bets. And what we're trying to do is really build platforms that we can pull levers on to open up the aperture and create a greater sort of like market share for the companies that we buy. And so that means not only are we buying big companies, but we're trying to grow them at scale, and sometimes that requires additional injection of capital on a follow-on basis. And so when you think about that in the co-invest context, you're not investing just once in a deal, you're investing perhaps multiple times with additional capital, and sometimes that's coming from different sources. Valuation then becomes something you need to keep in mind as well, right? So it's just such a nuanced dynamic to work with. But I think overall, our LPs are pleased with us, given the fact that we're able to offer them some of this co-invest flow that we do have because of the large size of deals that we do. But it's not an easy sort of thing to solve for. It's a Rubik's Cube that you kind of have to figure out, for each deal, how do you make it work? Who do you bring in? What's the timing? How do you allocate that? How many pools of capital are you pulling from? And all of those things just have to come together at the right time to get to closing.
Well, and I think it's so tricky because co-invest has become this top line fundraising topic. And it's complicated enough to solve the co-invest, challenge on a deal by deal basis, let alone try to solve it in a way that upfront you have a structure that works, that the cost of standing up whatever structures you do or whatever negotiation or strategic partnership that you have with an LP actually makes sense in terms of what then you can show and get them in the ground.
Right.
Yeah.
And as you know, you can't guarantee co-invest opportunities to LPs. And it's hard to predict what the future brings, right? You don't know just how much co-invest flow you're going to have. If you were speaking to sponsors in 2021, 22, at the height of a very sort of like a buoyant market, deals were easy to come by, and co-invest flow was almost like too easy, right? And now you're in a different market, but the LPs who underwrote their commitments to you under a different set of assumptions are now facing a very different market. And so they're asking questions. Why am I not getting more co-invest deal flow? Why this and why that? And we can see other sponsors so struggling with that issue. It's really hard to predict, right, what the market's going to bring. And so on the co-invest point, I just feel like it's a very dynamic space. I think GPs need to be very sensitive to how they think about promises that are made, right? How they think about putting the right sort of like policies and guidelines in place for the allocation, and then transparency. Back to what I said initially, right? LPs want to know what is happening behind the scenes. It's not just enough to tell an LP that, yeah, we'll come to you when we need your capital. They want to know like what the pipeline looks like. They want to know when to expect capital calls. They want to know what your co-invest, so the opportunity set is going to look like. And so all of that transparency and behind the scenes reporting adds an added layer of complexity to the dynamic that, GPs now also just have to deal with. Yeah.
So one question I like to ask sponsors with more developed co-invest programs is like, what do you wish that you had known before you started setting it up? Because a lot of times I see sponsors who think, hey, we're starting with one LP, we can be pretty dynamic with what we're offering to that person. We've had a long-term partnership with this LP, maybe not documented, but, no problem. We can guarantee the co-invest flow, or we can, ensure that they're getting priority, or, we're setting up maybe if it's just process, hey, we're setting up a process where, it doesn't matter. They can opt in on every deal, or we can deal with an opt-out right with 20 days for them to think about the deal. And it seems pretty reasonable when you start with the first one. And then as you layer on more and more, and this has just been interesting to me as a lawyer, is that of course we're sitting there saying you need to build something that's super sustainable, that is going to be able to scale, and is going to be something that you're going to be able to manage. And even with that advice, I think sometimes in the moment it's like, well, we just have these two partners that we typically work with. We don't need to think about all of that stuff. Yeah. So if you were giving someone some advice as they were starting to scale their program, what would you advise?
What would we do differently? I think thankfully we've been sort of maybe lucky is the word, maybe having enough foresight to actually have a good co-invest sort of process and plan in place, but it's not perfect. What I will say is with respect to the allocation point, we have this concept in our products where we have a major investor concept, investors who commit capital of a certain sort of threshold and size. We'll have first look at the co-invest opportunities that come through, and they're investors in the funds themselves, right? And so if you look at your top 5 or 10 largest investors in the fund, they know that whenever a co-invest opportunity comes around, they will get a first bite, a first look at it. But separate and apart from that, you also have standing pools of capital that are co-invest, so committed SMAs that want to invest alongside that. But they have opt-out rights. They're not always, so comfortable with every investment or the sizing of that deal, right? And so they want to know that they can opt in or opt out. That flexibility is really important for those investors, but the flexibility makes things hard for the sponsors. And so I think building a set of expectations or parameters around what an opt-out right might look like and when it can be exercised could be helpful for the sponsor in being able to at least have some certainty around availability of capital. And then lastly, side letters. Co-invest funds are becoming funds. It's literally a fundraise within a very short period of time. And what we're finding is, LPs are negotiating bespoke side letter terms for co-invest as well. And it's almost like a new fundraise. And so having good counsel who already fully understands all the sort of requirements of the primary main fund and trying to make sure that whatever new side letters are negotiated can dovetail well with the existing terms and provisions of the main fund is really important. If you don't have sophisticated counsel who have good funds experience, they might be great at doing the deal, but they might not know how to help you handle your co-invest process as smoothly. And that timing can also affect then when, your ECLs and your guarantees are able to be written and given to get to close on time.
That has been such a present part of my own career. I feel like when I was a junior associate, there's always been funds of ones, SMAs. I mean, that component of it, I think, has been around, although increasing in volume over time.
Right.
But, it used to be I would get tossed a side letter from one of my colleagues, hopefully more than a day or two before
Right.
the deal was closing.
That never happens.
This seems like something you might see in the fund formation practice. It's like, sure enough, I have before seen a sovereign immunity provision, and I can help you out with with this.
Yep.
But I mean, it has really migrated from touch points on deals to almost being a whole second part of what I do day to day.
Absolutely.
Is, hey, we are negotiating the main fund documents. We're negotiating those with the specter of co-invest over us and trying to think about what's going to make sense. Can we offer this provision when it's then turned around and offered in the single deal context? We have to have that conversation up front. We can't have the same types of transparency on a deal and in a fund without potentially really having some significant economic effect for the sponsor.
Right.
Like, you can't have the portfolio valuation on a single deal just
out
floating
there.
around.
Right.
And so it's now become this very interesting blended conversation where it's here I see you in the primary fund and now I see you in, 4 successive co-invests, and how do we blend your legal documents in a way that sort of, navigates you getting what you need and us understanding what you need and also trying to appropriately tailor for the circumstance.
Right. The other thing, as you were speaking, that got triggered in my mind is just there's an actual regulatory overlay to all of this as well, right? In terms of just liquidity rights and secondaries. When you think about it, it used to be you're in a closed-end fund, and so you didn't think much about the risk of giving information to one LP who was in the same standing as another LP that might help them to have better liquidity rights. But now, with a very active secondary market, an LP who receives additional reporting that all the other investors in the main fund perhaps not receive from the co-invest context might decide that they want to do a block sale of their investments in the fund. In the hedge fund context, you would call that sort of front running the rest of the LPs, right? Giving them liquidity preferences and information advantage, which you couldn't do. And in the PE context, that's not something you really think about. But now, again, because of the proliferation of secondaries opportunities, you really have to think about what reporting rights do your LPs have in the co-invest context, and might that give them an advantage to choosing to liquidate from your fund earlier than they otherwise would.
Even just liquidity within some of these co-invest structures,
Right.
Given that they have, and the reason why I now do much more co-invest is that we've now decided it's much easier for the co-invest entity in which the investors participate to just look like the fund, right? A lot of the new co-investors are not these sort of sophisticated, big, enormous check writing. I hear a lot of longer term co-investors talk about themselves as co-underwriters. We're in the chair with you. We're doing our own, work. We're,
They want to be
helping.
co-sponsors.
Yeah,
on the deal.
they really want to almost be almost on par with the sponsor.
Right. Without the fiduciary responsibility, might I add.
Of course. I haven't seen any of them take on fiduciary responsibility yet.
Right.
But there's so many co-investors now who are just in sort of the dollar cost averaging business, and they don't have the resources or the experience or the full underwriting capability of a lot of the sort of bigger traditional co-invest players from 5-10 years ago. And those investors don't want to be put direct into a deal.
Right.
Now, the sponsors may not want anyone direct in their deal anyway, but those investors aren't even sort of fully capable of underwriting a document that's as far off of the mark of the fund.
Yeah.
And so it's the more similar, the better.
Mm-hmm.
The documentation needs to sort of run as a nice parallel. And It's just been
In practice, it never works that way, right? It's like you dream up this, beautiful template that you're going to use for all your co-invest deals, and then time comes and you're like, all right, we need to renegotiate all of this and make it bespoke. But it's a great point that you raise.
One of the tricks I feel like of negotiating these co-invest arrangements is you have the people who come from that deal background and they have terms that they've had forever and ever that they want incorporated into a new structure that now isn't exactly apples to apples. And at the exact same time, you have these other investors who really are only familiar with the fund who want all of the same protections of the fund. And that doesn't really work either. And
right.
So I feel like
hybrid thing, right?
These discussions with investors, I do think that people are coming up the learning curve, and I feel like we will probably be in a much more efficient space in 5 years than we are right now. But it does feel like it's a little schizophrenic going from talking with one investor about why this isn't a deal structure from 15 years ago.
Right.
And then in the next beat, having a conversation with an investor about, hey, you can't just disclose all of this all this information publicly. I did want to come back to transfer and liquidity because I think that's such an interesting topic in the deal space in general.
Yeah.
The structures themselves look a lot like funds for a lot of these, and telling investors that they have affiliate transfer rights or that they're going to be able to engage in, maybe not affirmatively, but people assume that they are going to be able to engage in LP secondaries when and as they want.
Right.
It's I think a little bit of a trick in the context of a deal where that level of flexibility, this is one of those areas would not have fully existed in a sort of formerly direct structure.
Right.
And now you have LPs who are used to, well, this is just like a fund. Well, it's sort of like a fund. And should investors actually have the same level of flexibility to transfer out of a deal as a fund? I find it to be an interesting question that I don't know that we have an answer to, but I have had some sponsors now say no LP transfers.
Interesting. Yeah, we do get those requests from time to time. And of course, we try to be accommodating, right? We think of our relationships with our LPs as true partnerships, and where we can, help out, we try to. We can't always guarantee that you're going to have liquidity in a deal, especially depending on where the portfolio company is in its phase of, evolution, right? And so, like I said, we do a lot of buy and build sort of platform type investments, and the company that we start with might be very, very different from the company that we end up with, 3, 4, 5 years down the road. And so for an LP who comes in early in the deal, and when there's a new round of, say, a follow-on at a different valuation, and they're looking to make that an opportunity to either exit out of that deal or get liquidity, we look at that and we go, well, we're supposed to be in this together for the long haul. It's you're coming in for the full ride. And so back to the point about transparency and keeping LPs informed, I think to the extent that they understand what the transformation happening is at the deal level, and to the extent that they feel comfortable that they have a good grasp on what this investment opportunity is, that might affect their view on whether they actually want to, sort of sell out or transfer out of that particular asset or not. If they feel that they don't really know what's going on, they're probably more likely to say, I want to sell this because I don't know what that company is doing, and I have 5,000 of them in my portfolio, so who cares? Let's just do a carve out a block transfer and then sell all the assets in this particular deal and co-invest space. So it's tricky. It's really hard, and I feel like because the market continues to evolve, we haven't seen the last of this yet. We're going to see more changes in the fund and in the co-invest space, and I think we just have to remain nimble, which is why we need good counsel. Plug for Kirkland. When you have counsel who
nice advertisement. Thank you.
I know. You're welcome. When you have good counsel who can advise you on what they see, because they have such a broad swath of the market that they are servicing, I think that helps to actually be able to shape the market as well. So that's a good thing.
I did want to come back to something you said at the very beginning when we were talking a little bit more broadly about sort of what are investors thinking about and some of the friction that's being created in the fundraising process. you mentioned, they need bespoke reporting. You're getting sort of, having really more deep or intense conversations with investors on side letters. One of the things that I've really observed is, I think, the sort of peak of LP leverage. LPs realized that they could really ask for and demand a lot more in terms of specific rights. And that hasn't gone away, even as I think the overall balance between the LPs and GPs has leveled out a little bit. And so I'm curious if you had the experience. It used to be that side letters were like a process to get through. It was, yes, we all maligned that they were getting longer and longer. And of course, given that the original side letters were like 2 provisions, we pretty much only had one direction that we were going to go with side letters. Right. But it used to be, I think, a relatively smooth process. Like you might go a couple turns on a provision or 2, but it wasn't, people falling out of deals over side letter terms. Right. Transparency being one of them, it has been really interesting to me to see deals. I don't think I've seen them fall over very often, but genuinely side letter terms can be deal killers for investors now.
Absolutely.
And that was a long wind up.
We experienced that during our fundraise as well. I mean, like you said, investors are more sophisticated and they have more sophisticated counsel. And so they're starting out with maybe a side letter that they negotiated in the prior fund, but they don't give up any rights that's been negotiated. It's just cumulative. And so what happens is these side letters, expand. And the other thing is the MFN election process, because investors have transparency into that, even though they might not necessarily be able to elect a particular provision in a fund because they're not of the size. They see the provisions, and then guess what happens in their next fundraise? They're going to ask for those provisions as well. And the third factor is when you think about counsel, right? Because a lot of these negotiations are happening through like the law firms, right? And so counsel also know all of the technology that's out there in the market, and they know what to ask for on behalf of their clients. And because they want to be zealous and represent their clients and get all the best terms, what we're finding is, protracted negotiations between, the counsels on either side, representing either the sponsor or the LPs. All of that comes together to create a situation where, when I look at the number of side letters we had in Fund 8 versus 9, it's almost over 2.5 times.
Wow.
Right? The number of side letters and the
length.
number of provisions.
Yeah.
Right? And so now we're getting 60, 70 page side letters. And that's almost as long as the LPA itself. For some investors who care about having that many provisions, 100 plus provisions in a side letter. It's just, when you think about it, and then you think about the compliance aspect of it too, because promising to do something doesn't mean once the fundraiser is done, you don't have to think about it anymore. It's an ongoing obligation. And so you have to have a way to track all of these obligations that you're taking on the side letter. And many of them are springing. They're contingent upon some event happening. And so you need to pay attention to what's going on within your day-to-day operations at the firm. It might trigger something that's a reporting right in the side letter that you then have to go ensure that you report on time, right? And it's not upon demand anymore. LPs are like, yeah, we're not going to do that. You're just going to give us the right, and it's up to you to tell us when it happens. It used to be you could say, well, if you want it, LP, why don't you come ask for it whenever you want it, and I will give it to you. And now it's like, no, it's your obligation. You tell us. You have that affirmative duty. You need to report to us. I think that's a really underestimated operational burden on the sponsors with respect to their ability, right, to ensure that they're not violating the side letter terms. But it's a real problem.
That you need a bigger team to do what you're doing?
Bigger teams, better technology, and certainly more reliance on counsel. Just the cost of fundraising has also just gone up as a result. And I think, when LPs think about that too, they wonder why, sort of the org expense cap for the fund needs to be as high as it is. And what we try to explain to them is, look, it's a two-way street. The more negotiations we have, the more likely it is we're going to hit the cap. But obviously, above and beyond that, the GP now has to bear the cost of it. And so back to, fees and profitability, sponsors have to think about how much time do they want to spend with the side letters, the cost of negotiating them, and then the compliance cost of like making sure you don't violate them. And the SEC does care, right?
Yeah.
So
I mean, the space is just maturing.
Yes.
When I was, first starting to practice, it was not uncommon for you to get, I'm sure this is probably what your experience was,
Right.
2 questions in an email, 3 questions in an
Yeah.
email.
Now you have comment letter.
Now you have
Comment
a 25-page matrix of really sophisticated questions, and it's not. I think maybe investors think, oh, it's like rinse and repeat. You can
Right.
just take the answer from the last. No,
Right.
and there's obviously themes that develop, but even the angle or concern about any given provision might be like quite different from
Absolutely.
investor to investor. And so, I think the cost is a downside, and certainly I think for people who do what you and I do, that the time commitment is really significant in order to make it get done correctly. But on the plus side, I feel way better that people know what's in the documents, like that
Yes.
that there is an actual meeting of the minds, that investors are read in on, and should, if they're paying attention to what their counsel are telling them, should
Right.
really understand what it means to be committing to a fund. So, yes, a lot of process and cost friction, but maybe just some rising sophistication in the industry and sort of getting to more informed positions.
I think that's absolutely right. You're also seeing it creep into the diligence process as well. It used to be, and you guys don't get to see as much of this because we're the ones operating internally. When the initial diligence process begins, LPs used to have like a diligence list of maybe, I don't know, like 20 questions. Now it's 200 questions, and I'm not exaggerating. And it's everything about the firm, wanting to understand how you function, how you operate, what your internal sort of processes are. And so the DDQs leading up to like the legal negotiations themselves are an enormous undertaking. It's a huge burden, right? And you've got multiple of these. And I think part of what happens is for some LPs, it's a check the box exercise. They want to be able to say, yeah, we did appropriate diligence on this sponsor. And so they'll send you a diligence, questionnaire, and you fill it out. And then we don't know if they ever take a look at it anymore. For other LPs, it's just the launching off point to actually follow on questions and to a much longer, diligence process. They come to offices, or we have phone calls where we have long diligence meetings to talk through all the issues. And you're being benchmarked against a lot of other sponsors and peers.
Yeah.
And so that also sets the tone for, we see this best practice at this other sponsor. Why are you guys not doing that? And it's like, well, that's just not our business model. It just doesn't make sense. And so you have to spend the time to explain it as opposed to saying, well, that's just stupid. Like, we're not going to answer that question, right?
Right.
You've got to explain why the question is not applicable for you as, a sponsor, and why it might be applicable in a different context.